If you're within 5 to 10 years of retirement and have built up a significant nest egg in your 401k or IRA, but have no idea how to turn that money into a predictable monthly paycheck, then this video is for you. Saving money is hard, but actually spending that money safely without worrying about running out of money is even harder, especially with the markets that go up and down constantly. Today, I'm revealing the exact automated system that you can use to pay yourself every single month and how to manufacture cash by selling high and buying low. And make sure you stay till the end of this video because I'm walking through a hidden tax trap that catches many retirees off guard, and I'm going to show you what you can do to avoid it. But first, my name is Matz. I'm a financial planner at Oak Road Wealth Management, and we specialize in helping clients with $1 to $2 million saved for retirement create a confident retirement plan. For 30 or 40 years, your brain has been wired for one thing only: accumulation. You look at your account balances, and success means that that number is always going up. Your paycheck comes from your employer, and your savings are tucked away safely. But the day that you retire, this completely flips. Suddenly, that steady paycheck stops, and you have to pivot to decumulation, which means voluntarily watching your balance fluctuate while you're actually taking money out. The biggest hurdle actually isn't math, it's anxiety, because people are terrified to touch their nest egg because they don't know how to do it without breaking it. But let's fix that now by going through an automated distribution engine. You do not want to have to log into your IRA every month, guess which stocks to sell, and then manually move that money. This creates decision fatigue and leaves you vulnerable to emotional investing mistakes when the stock market drops. Instead, we want your primary bank account, either your checking or savings account, to be the command center for your retirement paycheck. You don't need a complex web of different investment buckets. Your bank account is the destination. The key is to securely link your investment portfolio directly to your bank account using an automated electronic fund transfer, or EFT. You set this up mechanically directly with the institutional platform that you're with, so for example with Charles Schwab, and then connect it with whoever you bank with. If you determine that you need $4,000 a month from your portfolio to live comfortably alongside your Social Security and any other income you have like a pension, etc., then you would schedule that $4,000 to land in your bank account automatically at the beginning of every single month. So to you and to your brain, nothing feels different at all. You're still getting a steady, predictable paycheck just like you used to when you're still working. Your lifestyle, it doesn't change, and your stress, it actually drops because now your life is more automated. But this leads to the obvious question, which is if the bank account is automatically pulling money from your investments every month, how do we make sure that there's actually always cash that's ready to go without draining your stocks during a market crash? Now this is where people make really big mistakes. They wait until they run out of cash and then they sell whatever investments they have, even if the stock market is down 20%. Now this is how you can possibly break your retirement plan. Instead, we want to refill your paycheck using a process called systematic rebalancing. Now let's look at a really quick example. Let's say that your target investment portfolio is 60% stocks and 40% bonds, and of course a little bit of cash. During a great market year, your stocks might grow significantly, pushing your stock allocation to 65%, leaving only 35% in bonds now. If you leave that alone, you're taking on too much risk. So what do? We rebalance. We sell the extra 5% of stocks that grew, and by doing that, we're actively selling high, taking those profits at the peak, and now where do these profits go? Now that creates cash for you, and any extra would get reinvested, probably back into some of those bonds that are now lower. So we're selling high, buying low. Conversely, what happens if the stock market crashes instead? Now your equities drop, and let's say, for example, that is 50-50, 50% stocks, 50% bonds. What are we going to do in this situation? This time we do not touch your stocks. We let them sit and recover. And instead, we're going to sell bonds to create cash. And of course, if there's any excess cash, we're going to reinvest that back into the portfolio This time, of course, probably the stocks. So again, we are selling high and buying low. This systematic, emotionless rebalancing routine ensures that your automated paycheck is consistently fed without ever forcing you to liquidate your long-term wealth during a market downturn. Now that we know how the mechanics work, we have to look at how the government takes their cut. And not all retirement accounts are created equal. Where you pull your paycheck from matters just as much as how much you pull out. So let's look at the two types of primary retirement accounts that you likely have. First, we have the pre-tax accounts, and this includes your traditional IRA and your traditional 401k. Every single dollar that you pull out of a traditional retirement account is taxed as ordinary income, just the same as your W-2 salary used to be when you were working. So if you're in the 22% tax bracket and you need to withdraw $10,000 from your traditional IRA, you don't actually get to keep all $10,000 because you have to pay federal and potentially state income tax on all of that money. Now on the flip side, we have Roth accounts. Because you already paid taxes on your Roth contributions, now all of that growth, all that earning, and all future withdrawals are going to be 100% tax-free. So if you pull $10,000 out of your Roth IRA to fund your retirement paycheck, you get exactly $10,000. If you aren't careful which bucket you pull from each year, you can inadvertently push yourself into a much higher tax bracket than you expected, which can cause a cascading effect on your financial plan. Now this brings us to the hidden tax trap that I promised to reveal to you. Many retirees think, I'll just let my pre-tax traditional IRA grow forever and I'll live off my Roth IRA and my brokerage account. Now this sounds very smart, but it's actually a trap. Under the current laws, the IRS actually forces you to take required minimum distributions, or RMDs, in your mid-70s, whether or not you need the money. So you're forced to take money out of your pre-tax accounts. Now if your pre-tax accounts have grown too large, these mandatory distributions can actually cause a massive tax spike. Not only will you pay sky-high ordinary income taxes, but this high income can actually also trigger massive surcharges on your Medicare premiums, known as IRMAA. It can also cause more of your Social Security to be taxed as well, up to 85% of it. Now to avoid this tax trap, you can build a deliberate withdrawal sequence. Instead of just draining one account entirely, you can pull proportionally from your traditional Roth and then taxable brokerage accounts to keep them perfectly balanced within your current tax bracket. Or in your early years of retirement, often called the gap years, before Social Security and RMDs kick in, you can actually systematically convert pre-tax dollars into your Roth IRA at historically low tax rates. Building a reliable, stress-free retirement paycheck takes careful planning. But once the automation, rebalancing, and tax sequencing are set up, you can actually enjoy the wealth that you spent a lifetime building. If you enjoyed this video and decided that you could use some help implementing these strategies, please click the link in the description below to set up an introductory call with our team to see if we may be a good fit for each other. But otherwise, thank you for watching, please like and subscribe, and keep an eye out for the next video.